to Wealth Dynasty. Glad to have you back. Today we will be talking about whole life insurance. We're going to do a high-level overview of whole life insurance. We're going to go through all the different subtypes and basically the different options that are out there, stuff that is now obsolete, and the most current and up-to-date types of policies that you want to know about, and just kind of an overview of which one works best for which situation, who's going to be, a best fit scenario for each of those different types of policies. So let's dive in. I guess we'll start out with the most basic question, and a lot of people might have this question: what is whole life insurance?
Okay, so we're going to parse that out a little bit because people think of whole life insurance, and the proper name should be permanent life insurance, because under the overall heading of permanent life insurance, whole life is one of those types of coverage. So whole life, indexed universal life, and variable universal life are all subheadings of permanent life insurance, which many people refer to as whole life insurance.
Great. That's a really good point. Usually people just know the word whole life, or and this is a very good distinction. Permanent means this is going to stick with you until you're done.
Correct. The idea is it's designed to last until you pass away. And there's all sorts of variations of that.
And also there's riders, so you can have additions to those different types of policies. Some of them are made or set up to generate wealth. Some of them are just purely protection. And we're going to go through a lot of those, all of those right now.
So let's just start with the topic of whole life insurance. Whole life insurance is a timeless product. It's been around for over 100 years, and it is the most guaranteed of all insurance products. It has a guaranteed premium, a guaranteed cash value, and a guaranteed death benefit.
Now, when you say guaranteed premium, is that essentially means that's not going to go up?
Correct. It's not going to go up, but it does mean it has to be paid. Okay. And it's not as flexible as other products in the premium payment. Whole life also pays a dividend in most cases. So most whole life policies are issued by mutual companies, and there's a dividend, or in some cases, it's an interest rate. The dividend is essentially a return of premium, excess premium that was not needed to cover the expenses and the mortality for that block of business, so to speak. So a dividend is paid back into the policy. It can be anywhere from 3 to 7 or 8%, depends on the company, on the year. Dividends can vary from one year to the next, so they're not guaranteed.
Correct. I mean, I imagine during COVID, there was probably little to no dividends during those times.
No, there were dividends, absolutely, because I'm not going to go too deep into that, but as you recall, COVID, really the biggest impact was on people that were already ill and or quite old. So the impact of COVID surprisingly did not have a huge effect on life insurance. Surprising. More interesting is that the AIDS epidemic back in the 80s had a more substantial impact because it was a different group of people. It affected mortality differently because it killed younger people.
Yeah. And they have obviously those data tables that, statistically these demographics are going to, and obviously with COVID, there was, the demographic of the older people that had already been calculated in that we're going to pass away anyways.
Correct.
So that makes a lot of sense.
Not that we want to, nothing, there's no happiness about any of that, but nevertheless, so that's the statistics behind it, or the truth behind it. So whole life pays a dividend. Dividends are not guaranteed, but they enhance the product. They enhance the policyholder experience considerably. And dividends are used typically to increase the cash value and increase the amount of coverage. So whole life, from a pure death benefit standpoint, is quite powerful in the later years because you pay the premium, it grows, and then the death benefit continues to increase substantially in the later years. Whole life can also be combined with a term rider, and then you got a base portion that's whole life, and then a term rider. The term rider has got more variability in terms of how much the cost might be. later on in life, but the cash value, of course, won't be nearly as big, or the increase in death benefit won't be nearly as big with some kind of term rider attached to it.
That's great. Yeah, great options. And who are the type of people that should be looking into something like a whole life policy? Who we
Well, whole life is great for the very conservative. Typically, you're going to get a return, 3 to 5 or 6% on the cash value over the years. Very safe. These are super safe companies with very strong balance sheets. They invest conservatively, mostly in bonds. So it's a conservative investment, long term. So that person that is interested in having a kind of a treasury account, if you will, very, very safe, which is not has no relationship to the market or the stock market whatsoever. And it's a good solid base for those that want that. It's good for folks to start off with in their 30s and 40s, maybe their 50s, with strong accumulation and strong death benefit. So got to be an important death benefit option. Death benefit has to be important, as well as the cash value accumulation. But it has to be someone that wants zero risk.
anybody that's looking to get insurance, they may have this is a purely insurance, like is not a strong investment, nothing that you're going to get a big return on. You just protection essentially.
It's protection, and it's like cash in the bank. Okay, it's very strong, very liquid
In there.
cash that's sitting there.
Okay. And as far as liquidity, how could somebody access that cash value? Is that like
Yeah, so they typically get it out in terms of a loan. You can also withdraw accumulated dividends if they have that, and they can take it out as a loan. And usually it's accessible within 4 or 5 business days. It's fairly quickly available.
that's a great option for, instead of having to take money out of a 401k or some other, qualified investor, or even you're unqualified. Let's say I got my Bitcoin and I'm never going to sell my Bitcoins, and you could take cash out of that and take a loan against it, and it's a great option. The loans now, though, that when you take that as a loan, that also does not count as income on your taxes, correct?
Correct. Like any other life insurance product, if you take a loan, it's money. It's your money back. It's non-reportable. There's no tax reporting on taking a loan out. And then the loan is paid off typically. If someone does that and they want to use it for life income, when they pass away, the loan is paid off by the death benefit.
Well, that's great.
And that's also tax-free,
Perfect.
or income tax-free.
Yeah, that's right.
Yeah.
That's good stuff. Anything else that our guests need to know about the whole life policies?
So whole life is kind of interesting. It's a very slow product. It's super slow. So whole life looked really, really good as interest rates are declining, because their general account, lots of bonds and so forth. They buy bonds, 30 years ago. As time goes on, if you're in a declining interest rate, the whole life looks really good. In an increasing interest rate environment, it doesn't look as great because it takes quite a while for the product to really catch up to the higher interest rates.
So is it best? It would be best for somebody to get this if they're going to go with the whole life. The best option would be to get this as young as possible.
Young, and there's all sorts of options on the whole life. And in other words, you can also do finance whole life, premium finance whole life. That also works pretty well in some situations. Whole life can be accomplished in a 10-pay format or a life pay format. Just depends on what the person wants to accomplish.
That's powerful. Yeah, you could just pay 10 payments for 10 years and the whole thing's paid off.
Paid off, guaranteed paid off.
Okay. What about a single payment? Let's say like I have a family member or something that passes away, or I sell my house or sell one of my properties, and I want to put that into an insurance. Could I make a single payment like that? Or
You can. That creates what's called a modified endowment contract, which sometimes that's okay. For the younger people, it's not great. A modified endowment contract works more like an annuity. You lose some of the tax benefits of the cash value accumulation on life insurance. You can't take tax-free withdrawals or tax-free loans, because any gain that's withdrawn from a modified endowment contract is subject to tax immediately.
so this would not be the perfect storm. Essentially, this would not be the product that you would want to use when in a situation like that.
No, typically, if you want accumulation for tax-favored, distributions later on, you want to fund that over 7 to 10 years at least. And whole life also, what you've paid into for quite a while, often dividends are available to pay the premiums.
So you can get to a point where you don't have to pay any more months.
Correct.
That's very powerful, especially as you get older. You're going to lose, either you lose your ability to keep working or you just simply retire. And it's good that thing can just take over by itself.
It depends on the product. It depends on the policy. Some are designed to be paid up in 10 years. Others with dividends can be, the dividends can start paying the premiums after 15 years or so. It depends on the product and so forth.
Now, just to so our viewers just have a ballpark of how much this would cost. Like, let's say, $500,000 or $1 million in coverage for maybe a 30-year-old, 40-year-old. Can you give us a ballpark there, or just
So whole life's an investment. In other words, you're putting money aside. It's not like term insurance where you're buying just a super low cost death benefit. Whole life is fairly substantial out of pocket. Okay, it does have cash value, so you're transferring money from one pocket to another, but it's substantial out of pocket. And with whole life also, payments pretty much have to be made. It's not like some of the other universal life products with more flexible premium schedules. Yes, you can borrow money to pay the premiums. You can borrow from the policy to pay the premiums. You can use paid up additions to pay the premium. But in the first several years, that premium really has to be paid. Otherwise, the policy could lapse or not perform as expected.
and if somebody has a whole life policy, let's say an old one, what's their best? I mean, should they just leave it and keep it riding, or would it be best to do a policy review if somebody has a situation like that? Let's say we have some of our guests that may have, oh yeah, I got a whole life policy back when I was 30 and I'm 50 now. Like, what would you do in a situation like that? What's best practice for them?
Well, best practice would be, yes, to review the policy, to do an audit of the policy. Is this still doing what you wanted it to do? In today's world, because you can get long-term care riders on life insurance, which is mean you can access the death benefit for long-term care needs. The old policies don't have that. And so lots of times repurposing a policy to give you the death benefit, but also allow you to have some long-term care benefits can be quite useful.
That's a great point. Yeah, very.
But there's other reasons too. There's a whole bunch of other reasons. This situation you change and the needs change, the goal changes. All those things can have an impact on whether you should continue it or not.
Perfect. So obviously, if you do have a policy like this, very, very, and how often would you review these? Would that be annual or every 5 years, or what's kind of like?
Well, whole life is very steady. If you reviewed it every couple of years, you'd be fine. It's a very steady product. It pretty much performs as expected.
So definitely sit down with a professional at that point with somebody that is competent and that has access to a lot of different products. Because if you have an older policy, even if it's 2 or 3 years old, 5 or 20 years old, whatever the age of the policy, that's very important to get a competent insurance professional to do that review. Make sure that your goals and your life situation still align with what you're trying to do with this insurance.
That's great for whole life. There's more to talk about that. We could talk forever about that, but let's go to that later. Yeah, let's move on to universal life, which is another broad heading within universal life, which is under the heading of permanent insurance. You've got current assumption universal life.
Current
assumption universal life. I'll go into that in a minute. You've got indexed universal life, and you have variable universal life. So let's talk about current assumption first. That's the most basic. That's based on the current interest rates. So current assumption is current interest rates. And typically it's got a guarantee rate of maybe 2%, something like that. But it will also credit current rates. And current rates, of course, vary from 1 year to the next. But the idea there is you've got and that can be a very low cost type of coverage to provide coverage for long periods of time at low cost. It's kind of a way to provide permanent coverage with the lowest out of pocket. It can have a big cash value accumulation if you allow it. You can put more money into it and have the accumulation. It's very safe based on, it's going to get current assumption, current rates. So right now, those are paying like around 5%, something like that, a little over 5 maybe. But, a few years past, it was down to 2 or 3%.
Yeah.
And in the way past, it was 10 or 12%. Okay, so it just depends on what's the current interest rates at the
This is
time.
an average over the life of the policy.
Right. So those are great when you have an increasing interest rate environment. Over, back in the early 80s, it was a, high interest rate environment. Those were fantastic then. Okay, but as the interest rates dropped, that performance dropped. Okay, so it's a simple product, um, but I think that's enough on that because you can have riders on that, everything else.
Yeah, the same writers that are going to
Yeah,
get most of these.
yeah, it's very safe. Whole life on a scale of 1 to 10, as far as safety, is like a 10.
Mhm.
Okay, it's super safe. Current assumption of universal life is probably an 8.
Oh,
Okay,
sure.
being safe, high numbers being safe. Okay,
And safe meaning this is a solid investment. I'm not going to lose money. I'm going to get, my money out of this and or my family is when I pass away.
Yeah.
So obviously.
That's right.
So and the death benefit's always going to be guaranteed no matter what. As long
Well, not necessarily, because on the current assumption universal life, the death benefit may be guaranteed to life expectancy, but the policy is designed typically to last, and you can actually design the policy to last to age 100, to age 110, whatever the time period is, knowing that once you get past the life expectancy type guarantee, it's the cash value is what provides
the death.
provides the support for the death benefit. So as long as there's cash value in there, even $1,
Yeah.
you have a death benefit. Okay. And so sometimes that I've seen people in the past have, managed these policies based on what they think their life expectancy is. And maybe they're going to live a little longer, so they have to pony up a little more money to pay for it, a couple more years. That's just managing the policy.
Yeah.
That's
That comes back to like the importance of doing a review
Correct.
on those policies, with your advisor, with your insurance guy.
Some people are comfortable managing it to age 95. Some people are comfortable at age 100. Some people are comfortable at 85.
Yeah.
Depends on
Depends on a lot of factors.
a lot of factors. Okay. But it's all manageable. And then we'll switch over now. Let's go to variable universal life. A scale of 1 to 10. This is probably on safety. This is much more risky. This is an investment, if you will. The cash value is invested in sub accounts, which are equivalent to mutual funds, and choose from a variety of different funds.
Or a mix between fun.
Oh, of course, a mix. Yes, a total mix, and your financial advisor can assist you on what your choices are there. It has typically these days they have anywhere from a fixed account. They might have even some indexed options, as well as regular sub accounts. And so there, of course, you're subject to market risk, both the death benefit and the cash value. But well-funded variable universal life policies, are fantastic. They last a long time. They have really good returns, assuming they're properly managed.
Correct. And why would somebody, I guess, get one of those above, a whole life or
Well, because they're going to probably use it for accumulation and future income, because the income options are still the same in terms of withdrawing money or taking loans, and your chance for accumulation is higher.
like what percentage these average at, or what do you kind of, what
What the S&P 500 has done, and you can kind of use that as an average. It depends on how it's allocated.
correct. And with these products, most companies have the downside. They take the floor, like a zero, correct?
No, not in variable universal life. With variable universal life, if the market goes down, your cash value is going to go down as well.
That's the risk it, and the risk for the risk it for the biscuit.
Right. Right. So, you have the opportunity for higher growth.
So essentially you could get, 30-40% if the S&P just kills it.
Yeah.
You could get negative 50, yeah, 30-40% if that happened on the downside. Okay.
Over time, it tends to balance out just fine, but you got to accept the risk. You got to know the risk going in.
And also I think this one is going to depend on your timeline, correct? Like, somebody in the 20s or 30s going to have a lot more time
Right.
for, to go through those up and down cycles, as opposed to somebody that's in their, late 50s, 60s, getting a policies that,
Yeah. So you think of it this way: you're going to be putting money into the market anyways, probably into a brokerage account of some sort. Here, you're putting your money into a mutual fund account, and those sub accounts are more expensive from a fee basis than many mutual funds are. Some are not, but some are more expensive.
they're managed.
They're managed funds. And so there's going to be some costs there.
Or because of the money.
And, or you can also choose indexed accounts with have low fees, but
ETFs.
there are some fees, associated with the underlying funds. Variable universal life tends to be a little more expensive in terms of internal costs. I think because of the additional trading that has to go on and so forth, that they have some additional costs. But it's an account that grows tax deferred, and you can take the money out, tax favored as well.
Very nice.
So it works from that, and it has a death benefit. Okay, so if something happens to you along the way, it's
And the death benefit's on top of your accumulation in the cash value or investment. Okay. So let's say somebody gets $1 million in death benefit and they're overfunding or adding, they could essentially have, much more than $1 million over a 30, 40-year period.
absolutely the death benefit can grow as the cash value grows.
That's very powerful.
Yeah. So it's very useful product for the right person. This is someone who's going to accept more risk. And then you've got what the most popular product these days is indexed universal life. That product came out maybe 30 or 40 years ago. I'm not sure exactly when. First, it seemed like a very complex product, hard to understand and also very expensive product.
Yeah. So these are what are referred to as IULs.
IUL, yeah, indexed universal life. In the last 15 years, it's really become quite a good product with lots of index options, the opportunity to allocate between several options in the policy itself for the cash value. In its most basic form, indexing works like this. You pay your premium, the insurance company takes that money, and typically they invest in mostly bonds with that money. And then they buy options against an index. And so as those options function, then what the insurance company does is they'll put a floor on the loss. So the typical floor is 0. So usually the worst that can happen in a given year, if the market performs poorly, your return is 0, but they put a cap on it as well. So if the market were to return 25%, your cap might be 10 or 11%, something like that. So the most you're going to get in a given year might be 10 or 11 or 8, depends on the company. And then the worst that can happen is a 0.
So this is you have a lot more opportunity for the growth, but less, on the downside, this is obviously less. Where would you put this on a scale of 1 to 10 for risk?
It's about a 6 or 7, I'd say. The variable life might be a 2 or a 3. Okay, this is maybe a 6 or a 7, in my opinion. Okay, and so you have the opportunity for growth, but limit the downside. It's very popular. People like it a lot, and it works really well. I've seen the policies over the last several years have all done quite well. The market's been, overall up, and there's a lot of varieties of ways they parse out the indexes, and so there's all sorts of ways to reduce volatility. You can do a 2-year index. Some even have a 5-year index.
So it doesn't lock you in for, like for the next 30 years, I'm locked in this
Oh, no.
single.
No, usually every year you can change the index if you wanted to.
Oh, that's good.
Or you can reallocate to different indexes.
So if you feel like, if there's a changing political scene or something that's happening in the economy that you see, you can kind of get it to in a different index where you think it's going to perform better.
Correct.
That's
You have more risk or less risk. And again, these policies are designed to typically last a lifetime. They also, like the current assumption, usually are guaranteed to life expectancy or a certain number of years. And then after that, the cash value supports the death benefit.
Tell me a little bit more. Explain that too. Some people might not understand what that means. The cash value supports the death benefit.
As long as there's $1 cash value in there, you can have $1 million policy, and maybe your accumulated at one point, maybe your accumulation was 500,000, but you started taking loans against it.
Okay.
All right.
Or using that money to pay the premiums.
Or usually, in other words, it might pay the internal expenses.
Yep.
Okay. And so it'll pay the internal expenses of the policy. Also, it can provide some income to you. So maybe after, you're 85, you stop taking income from it. Policy remains with a death benefit of, a couple 100,000 maybe.
Okay.
because you're taking money out.
Money out. Okay.
Maybe it's a couple $100,000, maybe another $100,000 of cash value remaining in it. And so what you'll do is take cash out. You got a remaining death benefit of maybe $100,000. I mean, sorry, a cash value of $100,000, remaining death benefit $200,000, or just as an example, right?
Yeah.
You're not paying any more premiums, but the internal costs it's designed to last until you pass away.
So okay, so let's say I just want to get $1 million, no matter what happens, of death benefit for my kids. You know, if when I pass away, I just want $1 million, and I don't want to
Don't want accumulation.
it's like, what would it be?
So then you use like a protective type or protection style index universal life, or a current assumption universal life.
Those are not going to accumulate
Not a lot of accumulation. You might have enough to pay yourself back after 20 or 30 years yet. Okay, but it's not designed for accumulation. It is designed to provide a death benefit for as long as you live.
Okay. So that's the one you guys want to look for if you just want that cash for the family.
Yeah.
That's great. So we've talked about universal life, the different types of the universal life, the whole life. What other permanent products are there that we need to be aware of?
Well, that's about it. Okay. So permanent products can be, as we discussed just a minute ago, for protection. They can be protection designed or accumulation design.
You're going to have to line your choice up with your goals and
Correct.
what you got going on in your life and family situation, whether you have a family or not, or, would these be, let's say, is this something that I would get if I was going to go into business with somebody and, I'm buying a business from a person, or we're business partners and we plan on being business partners for the next 10 years. Is this a product, or
It certainly can be. So let's talk about that a second, because there's all sorts of things to be done there. Let's assume that you have a business, you're a partnership, you're both married, have children of your own, and something happens to one of the partners. So the estate of the deceased is going to go to the family. So it could be the wife or the husband of the deceased partner is now the new partner in the business.
Okay.
Most business owners don't want that to happen.
Yeah, because unless they know what the business is about, or they have, maybe that person's the one with the experience and that other person is, taking those years to learn it from them. The spouse probably doesn't know.
They don't know. Typically they don't. And their goals are different. They want income now as opposed to growth.
Correct.
Those different goals.
Yeah.
So there's all sorts of ways to provide a buyout there. If the business is expected to probably grow and then they're going to sell it off in 10 years, I would probably just use a 10-year term, because that's just low cost.
Yeah, it's simple, but as easily as possible.
We have to,
The beneficiaries would be both business partners for each other.
right. And you can have multiple business owners
Yeah.
and do it differently. Okay. There's different ways of doing that.
Yeah.
It's really a subject for a whole new.
Yeah, we'll talk about that on the next.
Or else to turn this rate, or you can set it up so that the business is paying for a permanent policy. And so when the business separates, the partners can take their policies and leave.
So yeah, essentially, this could be a good product if you want to take those, get insurance now and take it with you after you're done. Always change the beneficiary after you're done with the transaction, and probably not the best case, for just, if we know for sure that we're going to be together as a partnership for the next 5 years or a given amount of time, probably term will be definitely cheaper and probably a better option for.
Yeah, just depends on what's wanted. And if the business produces lots of cash, then sometimes permanent insurance is fantastic.
Perfect. Oh, that's good. Yeah, that's a good point. So if your business is producing a lot of cash, this is a good way that you can accumulate, in one of these policies as an accumulation.
Yeah.
Yeah.
And there's several ways of setting that up, which we really could be hold of.
Yeah, we'll talk about another episode. Yeah.
I think that's pretty much it. I think we've covered the basics there. Permanent policy can be protection design, accumulation design. Whole life is somewhere in the middle, I would say. And then it could also be designed as much or as little risk as you'd like to accept.
Perfect. We're here to serve you. Again, if you have a policy that hasn't been reviewed in a while, definitely check out this video we have with Kevin Kimbrough about policy reviews. Very, very important, just to give you an idea, whether that's with us or with whoever your trusted licensed insurance agent is. Make sure you do that, because obviously you want to, keep all this stuff up to date.
That's a wrap.
Yep. We'll see you guys on the next episode. Thanks.